Hello and welcome to the Harwood Report for February 5th, 2019. I am Keith Harwood, the host of the Harwood Report and the founder of Trade Academy. Let's do disclosures and then we'll get to the content. All services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to read through the rest of those and then I will start talking charts and my thoughts on the markets. All right. That should give you a time here. So I want to talk a bit about what equities are doing because it's a little interesting. Bonds are a little unclear to me. Gold is setting up an interesting opportunity and oil is chopping. So let's focus most of our energy today, I think, on these guys and this stuff. And so first off, I always like to look at the Fear and Greed Index because this is a good little indicator of where like retail and Panic and everybody else are going to be getting their stories when they're watching financial news networks. This actually is starting to get pretty greedy here, this market breadth. Everything has started to get that strength. That's a good sign for the overall market, but it does start to give me a little bit of concern that maybe we're going to be a little overbought and maybe there's going to be a little bit more stock picking going forward rather than this just massive rally that we've had. This means nothing to me. This is starting to show more signs of normality. It's not extreme greed necessarily for this to be kind of flat. This was extreme fear. This looks a lot like it did for much of 2018, where we were kind of around that flat line. This is neutral. Look where we were relative to 2018. This is neutral. Look where we were relative to 2018. This doesn't matter. And this is not extreme fear to me anymore. It's getting very close to neutrality. We're back to that point. It's kind of been a stall. So you see it held. We didn't get back above the 125-day moving average in October, November, or December. And now we're going to test it again. There are other moving averages that I prefer to look at, but the 125-day is one that they like because that's about 6 months of trading days. Particular charts here. First off, S&Ps. Looks like a magnet to the 200-day. We're almost there. That creates a consolidation event. The VIX is telling us that that's exactly what we're going to be getting. We have now breached the lows in the VIX from November and from, well, I guess that was still November 8th. So all of these lows that were occurring in the VIX, we've broken below that. Means that there's less fear in the market. I don't see us having to have a washout event from here. We don't need to see the market collapse. That weak hand that needed to get out before the end of the year did so. They took their tax losses. People don't need to take tax losses in February or in February. We should not see a move back down to here, without a very bad fundamental update on, say, the China trade war. Even a lack of resolution on the trade war can probably keep us here above these kind of levels. Because if we keep kicking the can as we have, it's slightly negative relative to where we were in October, where we thought everything was going to get resolved. But it's not as bad as December, where there were tax loss sellers. We're, I think, more like the October sellers, which is 4% down from here. So let's not say it's nothing, but it's not nearly that extreme potential to me of 10 to 12% from here. A lot of times these key moving averages create a little consolidation. We chopped around it here. We chopped around a little bit here. Here it was just a quick fall because we had a bad fundamental update on December 4th. But, we've got these times where we chop around key moving averages. That creates a setup where I use something either like a butterfly or a calendar in the option space in order to play for lack of movement. So I'm not looking to play for incredible movement. I'm playing for lack of movement when I do something like that. And that's kind of been my my thesis here going into this week, is more of lack of movement and stock picking. So speaking of stock picking, I'm going to show you guys JCJ, the Sibo correlation index. Oh, they don't want to show it to me on this. All right, so I can't pull up the correlation index on this charting system. I forgot that. But it tells us when all of these stocks are correlated, and they are highly correlated right now. It generally starts to decay as stock picking starts to come into the market. Let me just make sure that they don't want to give me a different index on it. Okay, so they can give me, I don't think KCJ shows anything, but I'll pull it up anyway. Yeah, so it's not really meaningful here, but you can start to see that the normal behavior is that sort of decay as we get out of the first quarter, where it kind of is a slow drop and then a faster drop. That's what I expect to start seeing coming through the correlation indices here in the coming months, as people turn towards stock picking rather than market buying. Let's go to Qs. Oh, Qs, the wonderful tech index that was beaten down hard as panic ensued because things like semiconductors, SMH, were showing so much negativity. Well, SMH is now almost back to that 200-day moving average as well. It was a little stronger than Qs, frankly, because we're testing the December high and even getting close to this October high here, this mid-October high after the collapse. So when I look at the Qs, they're a little bit behind that. We're not very close here. We'd have to get to another 4 or 5% to get to that level. We're getting close to this one, but SMH is a good leading indicator on the tech sector, and I think that it's telling us that this market still wants higher. But again, I still think that we're going to have to do some consolidation as we get back towards these key technical points that are going to provide a great amount of resistance. It's a spot where people that were buying in here and even up to here may look to take some profits. It's not a spot where people are necessarily initiating shorts. It's that these buyers have seen a really nice run, and now we hit a technical level, a retracement level, a level that maybe they got out the first time. If you were very smart and you were doing a lot of technical trading and you got very fortunate with your timing, maybe you saw somebody get out or even get short here and then get back in, just off of the fact that we were so oversold down here, and then start building along as we cross some moving averages here. And then we get to this key moving average and say, look, I can take some money off the table. If I'm long from 156 all the way to 170, that's almost 10% in a month. It's a pretty good return that can justify maybe taking some profits. Okay, so it's the guy that's making money that tends to come in and start taking some profits there, while other people that are looking at the long-term potential and saying, 170 in the short term, 171, 172 may be a consolidation point, but in the long term, we're going to get back up to here. So a guy with like a 6 month or a year or a 10-year time horizon isn't necessarily looking to sell on a move back to 172. A guy with a couple of month time horizon may look to sell. And then if we get a fundamental update that's bullish or bearish from China, then they have clean powder to just decide where they want to, dry powder. They have a clean book to then look at how to express the next trading view. If I go to IWM, it has been a lagger to the tech sector for a year now, and it really got hit here. Now, it started this move higher, but it slowed. You can see that it's very similar to tech in terms of how far it is below these numbers here from October, November, and early December. So it's not as close to the 200-day moving average. IWM has some catch-up to do. If the U.S. Economy is strong, small caps often lead because they are very domestically focused. If the world economy is strong, tech can lead. Well, the tech sector has led for the better part of a decade now. IWM has a lot of financial exposure to it, and financials had very good earnings in general that helped get them a little bit of a spike up here. But they've just been consolidating ever since earnings. There's been no follow-through. There still seems to be a lack of interest in allocating capital to the banks, the financials. If that starts to shift, if we start seeing some upgrades maybe coming from some of those banks themselves, then that may start to change the tune and get a little bit more money flow into IWM. I'm looking for that to occur. IWM, I think, instead of doing those calendars or those butterflies, I think this has some continuation potential for it. And so I'm looking at something like a simple call spread to get the market all the way back up to here to 158. Because remember, if I think SPY has $1 of upside, so less than 0.5%, but I think that IWM has $6 or $7 of upside, so like 4 or 5%. Where do I want to put my capital? With a long bias. I think I want to put it in IWM. Even though it's been a lagger, I think that money rotation can help bring it back around. When I go to TLT, I look at this and I say to myself, this is going nowhere fast. Okay? Every time it dips, there's a buyer. Every time it rallies, there's a seller. It's creating a bit of a wedge here. You can start to see this the range is tightening up a little bit, and then that creates a more exciting setup. If volatility in TLT starts to come down to match the historical volatility, this actually creates a really nice explosive setup, looking for a breakout to the upside or a breakdown to the downside with cheap options. Options aren't cheap yet, and this coil doesn't look like it's contained yet. It's not quite done. So until it's done, I don't really want to get too aggressive with this. So I want to wait for this coil to continue to form, tighten up those ranges, compress that volatility, and then look for the breakout. The more exciting setup for me is in gold. So I'll show you GLD first, which is starting to tiptoe down. You'd have two arguments here if you just look at this from a technical perspective without any other indicators. You'd say we had a breakout here, a new high, a small pullback, creating like a bull flag, bull pennant type situation, looking for a new move higher. When I look at the dollar index, it is strengthening. That is a bearish input for gold. When I look at dollar yen, it is strengthening fairly rapidly and starting to get above some of these recent levels. So all of a sudden, dollar yen looks like it can get back up to 112. Dollar index looks like it at least wants to retest the highs of this range, which are kind of right here at the, which moving average is that? Sorry, that's the 50-day moving average. So 96.40, a little bit more upside. And that could basically negate that bull flag, bull pennant scenario and create a washout down to 121 or lower. We could even break down below this. So 121 or 121.5 seems like an easy intermediate target. Perhaps people are buying a little bit of gold ahead of some events, such as the State of the Union address or concerns about China. But in the meantime, if we start to dip a little more, all of a sudden the bear starts to get control, get us below the 10-day moving average in particular, and the bear gets a lot more control, and we start to see a press down. Now, this move here could just be a stopping point, a stall point for a couple of days before a bigger break all the way back down to 118. I don't know if that's going to come through that way, but the way that the dollar is starting to move right now starts setting me up for a little bit more excitement on the bear side of gold. The other thing we're seeing is if you go to the gold miners, you can see that they are starting to still kind of coming down a little bit more today. They were very overbought as well, but they're not in the green today. So gold is up small today, but the miners are starting to get some money flow out of them. Almost as if people are starting to say, look, this is a little overdone. So I'm looking for some of that profit taking in that, plus that bullishness in the dollar to create some pressure on gold and all of a sudden help bring it back down. So that's a big one for me because volatility there is actually very cheap. I can do this with outright puts and get some real leverage. So I'm going to be looking at some more of that today and tomorrow. I do want to have something on there by the close today because I'm going into the State of the Union address and I want to have something on so that if and when the relief break in gold occurs, I think tonight could be a catalyst for it. Okay, so that's gold. Oil. So first I'll just look at oil, and then we'll go over to the XLE and OIH. USO, is consolidating. It's not doing anything too exciting right now. It's above the 10-day moving average, but it's below the recent highs. So where does it go from here? That's going to be determined by probably some of these fundamental inputs. If the stuff with China gets a little bit better, that can create a little bit of bullishness for oil. If the dollar gets a little stronger, that could be a little bearish for oil. If the stock market gets stronger, that could be bullish for oil as a sign of macro strength. So all these things are kind of right now trying to resolve on whether oil is going to be bullish or bearish. Now, if it's bullish, what happens in XLE? We would expect it to have some follow through. Now, XLE is continuing to drift higher while oil hasn't fallen. So that's telling me that maybe people are starting to think that they were over or under allocated to these oil names due to the big drop that we saw. OIH tends to lag XLE a little bit, and you can see today it's still doing the same thing. So it looks a little bit more like USO, while XLE had a little bit more firmness. So if XLE continues higher and I start to see USO, so if I start to see oil firm and I continue to see XLE firm, I want to start looking for some leverage in OIH. These consolidation periods help knock volatility down. We're starting to show some signs of extra strength here, trading to new highs of the recent move in OIH. And that sets up for an easy move into the 19s and potentially all the way into the 21-ish range, where we consolidated in November. That's a big leveraged move if it occurs that way. So I've got a close eye on that, watching USO, and if that USO thing happens, then I start looking for outright calls in OIH. But until I see a USO firm, I don't want to get too aggressive with this. So again, my big thing right now is that I think gold has a potential for a pretty quick drop, and I'm looking for something leveraged there. You want details, you got to sign up for the Harwood Report. I put out a newsletter on Mondays. That's already out. The specifics of my trading ideas for how to trade that consolidation in SPY, that extra bullishness in IWM, that bearish potential for bigger move in gold, and then how I'm looking at weighting it out in USO and XLE and OIH. It's all outlined there with actual trade concepts that kind of help illustrate the concepts that I'm trying to explain here. I also do a midweek update to help subscribers understand exactly how the 2 days into the week have really adjusted the market, because every day enough information comes into the market that we have to have little nuanced shifts. If gold breaks from 124 to 123, is there the same leveraged play out there, or is there something different? Is there new information? All right, and if you sign up now, you get that first week for free, and after that, it's only $49 a month. So it's a very reasonably priced newsletter. Gives a lot of good information. I think it's worth multiples of that number. And if you get that first week for free, you can really get take it for a test drive and see what you think. And you can always email me, keith@tradeacademy.co, if you have comments or questions. Thanks again, folks. And I look forward to having you subscribe to the Harwood Report. Have a great afternoon.